Welcome back to the Commercial Real Estate Show. I'm Michael Bull. We're talking with Ryan Severino with REIS, and we're talking about the self-storage market. And Ryan, it's been an active market for investors, hasn't it? Seems like a lot of investors are more interested in the self-storage sector than they used to be. What have you seen for sales volume in this sector?
You're exactly right, and obviously this year hasn't ended, but as far as I've seen through the preliminary readings, it looks like volume this year is going to be higher than last year, which is higher than the year before. And I think you hit the nail on the head when you say that this is a property sector that increasingly investors, including institutional investors, are training their sights on. I think as we've seen investors become increasingly priced out of other asset classes or not yet willing to take serious development risk, even in apartments where I know the property sector is booming and the availability of capital, it's a veritable deluge. But I do think investors are approaching those other sectors a little bit more cautiously than they have before. And in a world that's increasingly on a hunt for yield, this is a property sector that offers attractive opportunities. And so I think irrespective of exactly where the transaction volume ends up coming in this year, we're going to see fairly significant volume for what I consider to be a secondary property type, well ahead of where we've seen the sector for the last few years coming out of the recession. So I think interest is up and volume is up, and I think the empirical evidence is pretty strongly in favor of that.
Well, as these investors are searching for yield, it seems like the self-storage market is interesting. As you said, it's fairly stable, and I like what you said about even the older properties maybe keeping and retaining tenants. So what kind of yields are these investors looking at? What do you see for cap rates on some of the various classes?
Overall right now, cap rates are probably in the, say, 7 to 8% range overall. I'd say for the really high quality, good quality deals, fully leased, or pretty close to being fully leased, very stable roster of tenancy over time. You're probably looking at a little bit of a premium to that 6 to 7% range. While cap rates for deals that are, maybe not the best quality, struggling to maybe lease up a little bit, or have had some histories with occupancy in the past, are probably more in the, kind of the 7 to 9% range, maybe even 8 to 9% range. I'm obviously generalizing a little bit, but I think that gives you an idea of how this market is shaping up for this year. And again, I do think that investors are out there on the hunt for yield, and if you look at self-storage vis-a-vis, say, apartment, you can probably get it, depending upon the market you're in, a 100 to 200 basis point spread, which is, not to overstate this or be too hyperbolic, but that's kind of gold for investors these days that are often dealing in a world with microscopically low cap rates right now.
Right. Yeah, it can be a good alternative. Well, how is these cap rates trending, Ryan? Have they been compressing slightly? What's the trend there?
Yeah, cap rates, like other major property sectors, are down this year. I would say the cap rate compression that we've seen this year is slight compared to what we've seen over the last few years. Maybe 50 bips or less, depending upon the market you're talking about this year. But the market has been on a run for the last couple of years. So if you put it into the broader context of what we've seen for the last couple of years, cap rates are definitely down. From average cap rates coming out of the recession, we're probably, again, it's market specific, we're probably in the 8 to 10% range, and now we're probably down closer to the 6 to 7% range. So depending upon where you are, we've seen probably a healthy couple hundred basis points compression over the last few years. And I'd say that's indicative of a healthy market that investors are increasingly feeling more optimistic about.
Yeah, and that's positive. If you're an investor, then you realize that people have faith in this sector. And I guess if you're an owner, maybe you're a possible seller at these low cap rates, especially if interest rates start to creep up in 2015. So what does your crystal ball say, Ryan, for cap rates, and especially with that we may have some increases in interest rates?
I know interest rates are likely headed upwards sometime next year, but I think, and you and I have discussed this in the past, that there isn't a perfect one-to-one relationship between interest rates and cap rates. And so interest rates, I think, are almost, it's inevitable at this point, given all of the strength in the readings we've seen from the economy, right? GDP is growing at an accelerating rate. The labor market continues to post better and better figures seemingly every month. And so at some point next year, probably mid to late year, we're going to see the Fed start raising interest rates. Although I'm probably less bearish about the long end of the curve than the short end of the curve. I think you'll probably see some flattening out there. But either way, the good news is if all of that transpires, and I don't see why it won't, that generally means that NOI should be growing up, which will put downward pressure on cap rates, whereas premiums will compress as the economy continues to improve, which will put downward pressure on cap rates. So I think our general outlook for cap rates, or at least my general outlook for cap rates, is kind of flat to maybe slightly downward. I think most of the cap rate compression in commercial real estate, including self-storage, has probably transpired over the last few years, but I think investors who are sitting out there on the fence may be worried about significant cap rate expansion over the next, say, 2 to 3 years. I think that risk is probably a little bit overblown. I don't think there's a lot of risk for cap rate expansion in the short term, maybe not even so much in the medium term. You kind of have to get out to longer term, 5 to 10 years, I think, before you really have to start worrying about cap rates expanding.
I see. And that sounds like you're saying it's mainly because we're going to have such a strength in the economy and in the fundamentals that you believe that extra investor demand is going to keep cap rates intact.
Yeah, I think I really believe that. I think a lot of investors have been sitting on the sidelines in markets over the last few years because they've been concerned about the economy. They've been concerned about where to redeploy capital. Outside of apartments, development opportunities have not been incredibly abundant. I think the economy is going to unlock more investment opportunities than we've seen over the last few years, including for self-storage, because like we were talking about, a lot of the factors driving this sector, as the economy improves, as the labor market improves, as people start to move a little bit more with the health of the housing market, all of that is good for the sector, which will mean higher occupancy levels and stronger rents. And so I think all of that is good news for not just the fundamental side, but I think the capital market side as well. Okay.
And let's talk about the sector when it comes to new supply. What kind of new supply, new construction volume are you seeing? And are there any special aspects to new supply in this sector? It seems like the construction is pretty straightforward and simple, and that in some markets there's no real barrier to entry. What do you see there, Ryan?
I would say you are 100% correct on that, and I would say this is probably the biggest risk right now for the self-storage sector, construction, in that we are starting to see a fairly significant escalation in construction activity, not just this year, but going forward for the next couple of years. It's pervasive across the country, because think about this property type, right? There are relatively low construction costs because it's not overly complicated. It's fairly easy to build relative to other property types. It's generally not as expensive. They can be built, they're still tending to be in the millions of dollars range, but it's very different than building an office tower, an apartment tower. And you're right in that a lot of markets, the land is not a significant barrier to entry. So I would say it's as true in self-storage as it is in the other significant property sectors, in that it's harder to build in the supply-constrained markets, especially the coastal markets, and so that insulates them a little bit. So if you're talking about Brooklyn or San Francisco or someplace like that, the dynamic's a little bit different than if you're talking about some of the Texas markets or the Carolinas markets. But that said, I come back to that point about the tenure of your tenancy in a building, and that often you find, even if there's a new game in town, you don't see people jumping ship the way you do in some of the other sectors, because it is kind of a hassle to move your things. And so I think that's the new development tends to be more of a risk for newer buildings that are really trying to stabilize and lease up than it is for older assets that are trying to hold on to their tenants. And so I'm not saying it's not a risk at all, but I think it's more of a risk for the people who are out trying to develop right now than it is a risk for people who have existing assets that are sitting there, 95% occupied, worrying about new competition in the marketplace.
Well, as usual, Ryan, great information. Thanks for joining us today.
Thanks a lot, Michael. Happy holidays.
Well, thank you. And if you'd like more information from Ryan, visit REIS.com. They track every sector in commercial real estate. You'll be glad you did. And thanks for joining us. Now, we'll be right back with more on the self-storage market. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's REALNEX. FIU, Florida International University. Earn your master's in real estate in as little as 10 months without interrupting your career. Visit FIUonline.com. Xceligent, the resource professionals use for commercial real estate information. Visit xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies or for additional videos, podcasts, or articles, visit CREshow.com.